today's webinar is, why is funding my business so gosh darn difficult? First, I'd like to give you our communication information. We're with Navocate Business Sales and Acquisitions. You can reach us on Twitter at Navocate, on Google Plus at Navocate Acquisitions, or you can send an email to me at carl@navocate.com. First, I'd like to introduce Ruth Hedges. Ruth is from Funding Roadmap. Funding Roadmap is the official business plan and deal flow resource for all Navocate transactions, and they're the sponsor of today's webinar. Funding Roadmap provides businesses a much-needed conduit for online business planning, due diligence, and financial reporting. Ruth is the creator of FundingRoadmap.com, and as CEO, she's responsible for overseeing and directing all facets of the company's development and operations. Ruth has an executive managerial track record spanning over 27 years in sales, marketing, and strategic development. She has been featured in the Chronicle of Philanthropy, as well as the New York Times, the LA Times, and People magazine for her work with Oxfam America and the Hollywood Hunger Banquets. She was also once featured on ABC's Home Show, and the Financial News Network did a two-part series on her for the show entitled American Entrepreneur. So, Ruth.
Hi, everyone. Thank you so much for joining Carl and I today. We are all very excited that you have taken the time from your busy day to participate in this, and I'm sure that you're going to be pleased with the information that you learn about how to help get you funded faster. One of the reasons why we built the Funding Roadmap was specifically to help people access capital and to level the playing field so that you can provide information about your company in a compliant and transparent way to investors and lenders anywhere in the world. And one of the problems with a traditional business plan is that it is too heavy in text. It's full of a lot of boilerplate, a lot of text that does not allow an investor or a lender to get to the answers of the questions that they care about most. So what we did is we took those questions, which are found in a typical business plan template, which you can find these all over the internet. The problem with these business plan templates is that they were written originally on a typewriter. And unfortunately, they're in a PDF format. And the problem is that there's no calculations built behind any of these types of spreadsheets, like a balance sheet or an income statement or cash flow statement. So one is required to figure out how to build these financial statements and then transpose the numbers from one statement to the next. And obviously, in this type of format, there's a lot of miscalculations and loss of integrity between the mathematics of the calculations. The other problem with this type of business plan template is they give you all the questions, but they don't give you any of the answers. So what we did is we tried to solve both of these problems, and that's what we did when we built the Funding Roadmap. The Funding Roadmap is on the cloud. You can access it from a computer or smartphone. You can access it from an iPad or any other type of tablet. And basically, you just log in, and you log in, which I'm not going to do because I've already logged in. But when you enter into the Funding Roadmap, an investor or lender can learn all about your company through different mediums, one of them being a video. You can create a video of a prototype of a product. You can have an interview of your management team. You could take, for example, if you had a restaurant, you could showcase the menu, the ambiance, the line out the door, all of these kinds of things, which would be much more compelling than just reading a traditional business plan. We also integrated Facebook, LinkedIn, and Twitter, which is very powerful as well, to be able to show an investor or a lender your fans, followers. That's a powerful thing today, and it adds an enormous amount of value to your presentation to an investor. And then below this is the executive summary. And all of these pieces can be submitted so that you can showcase this to a virtual marketplace, which we built on our website as well. Then we took the questions that you saw on that business plan template, and we created a system where each of the questions are hyperlinked directly to the answer. So it's the same questions that were on that business plan template about marketing and operations and pricing strategy, competition, management plan, break-even point, financial feasibility. All of these questions are directly linked to an answer field. And this, again, changes the way an investor can look at your idea, which is going to make him more interested in actually considering your idea for an investment. And when he gets to these answers, he's going to find one of two things, either a drop-down menu with multiple choice answers, which obviously make filling this out a lot simpler than that business plan template, or he's going to find text fields where you type in the correct answer. And when you're done, you just save the answer because it's all built in the cloud. And then you can click on the question and go right back to the answer and check it off. So as you check off these answers, you are benchmarking the progress that you're making. And then you have an accurate way for an investor to come into the system, find the answers that you've completed, click on them, and go directly to review them without having to read through pages and pages and pages of a long, lengthy business plan. We also built in the due diligence report, which is not in any other business plan type technology, and this is really where the funding happens. I don't know if any of you have ever done any research on due diligence, if you've ever been through the due diligence process, but you will be required to disclose everything about your company's structure, the shareholder list, your financial records, tax information, insurance policies, if there's any criminal proceedings against anyone, copyrights, trademarks, and patents. All this information will be required to disclose during the due diligence process for any kind of funding, whether it's venture capital, angel capital, a small business loan, an SBA loan. You will have to go through the due diligence process. So what we're saying is one of the ways you get funded faster is if you are prepared ahead of time to go through this due diligence process and immediately present the documentation to an investor or lender way before they ever ask for it. The last piece that's critical to getting funded is financial statements. And we built the easiest way to build income statement, cash flow, and balance sheets. We actually built all the calculations into the report, and all you have to do, and they're all linked together. So you don't only have to put the number in one time, and then in a field here where it says white is an input field, and then you automatically go to the bottom of the report. You click Save File, and it builds this entire spreadsheet for you, and it pulls the numbers from one report to the next. So there's no loss of integrity between moving numbers from one sheet to another, and at the end you have the current and 3-year pro forma financials. When you're done with all the financial statements, if you are interested in applying for a loan, we even built a loan application into this. Again, it's built the exact same way as the rest of our reporting system with multiple choice drop-down menus, and all the calculations are built in. So it makes it extremely easy to be able to fill this out correctly. And that's really what we're talking about today. Part of the reason why a lot of people don't get access to capital is because they're not really prepared and they can't get the attention of investors. This reporting system helps you build a transparent and compliant report, complete, accurate, and is going to help you in immeasurable ways to be able to convince an investor or a lender that they should give you funding. In addition to that, there's one more thing I want to show you, and then I'm going to hand this over back to Carl. One of the other problems with writing a traditional business plan is that you are then challenged with how do I present this to investors and lenders. And obviously, if it's sitting on your desktop or it's printed in a drawer, that becomes a really difficult thing to do. So what we did is we built a marketplace, and we gave our subscribers an opportunity to showcase their idea to a world of potential investors, because there are billions of people on the planet. Just as we know they go to social media marketplaces, social media sites like Facebook and Twitter, and there's, I think 750 million people on Facebook today and several hundred million on Twitter. They can come to this type of marketplace and they can review your idea. You can market your product, your idea, your venture, using the video, for example, using your executive summary. People can watch the video that you put in your funding roadmap right from the marketplace. They can read your executive summary right from the marketplace. And they can even vote for your idea if they like it. And then they can contact you by email. So this is how we've made this process exponentially faster and more efficient, and opened up your possibilities for getting access to capital in ways that have never been possible before. And these are just some of the companies that are on our marketplace. You can come here. The marketplace is open to the public, and everybody can sign up on the marketplace for free, and you can also review companies and see what kind of companies are on here. Carl, do you want to ask if anybody has any questions? They can put their hand up or type it in the field, or how do you?
What we'd like to do is go through the presentations completely, and then you have a Q&A box on your WebEx window, so you could type questions there, and then we'll answer them together, because as we go through the rest of the presentation, there may be additional questions that come up about the funding roadmap and the marketplace, and so we'd like to hold the questions to the end, but you can certainly type them in now at any time. Ruth, are you all set then?
I'm good.
Okay.
Thank you.
Great. Thank you. We're now back to the presentation. So, Ruth, let me ask you, if people wanted to contact you, what's the best way to do that?
It's info@fundingroadmap.com.
So that's the contact email address, and you
Yes.
can see that Funding Roadmap is a very powerful tool that's available for not only developing a business plan online, but for online collaboration and for posting your business and trying to get funding on the Deal Flow marketplace. So Ruth will continue to be on this presentation as we go through the rest of this. And Ruth, I want you to please add comments as we go through where you have observations based on your experience, or you see some tie-ins
Sure.
or some ways for Funding Roadmap to continue, or Deal Flow Marketplace to continue to support what we're going to talk about.
Sounds
So
great.
let me move on to the next. We are a company called Navocate. We're a business sales and acquisitions company. I'm Carl Buell. I'm going to be a presenter today. My previous history is Fortune 50 executive management and also an entrepreneur, a former Microsoft exec, where I handle business development, international marketing, government affairs, among other things. We're joined today also by Boaz Vinogradov. Boaz is a former president of several Israeli technology and medical companies, and Boaz has done a lot of work in the area of funding. He brought several companies public on the NASDAQ exchange and the Swiss stock exchange, and had worked with venture capital firms as well to do that. So he brings a lot of experience, and we're going to tag team back and forth for the rest of the presentation here. What Navocate does, just very quickly, we provide business sales and acquisitions services for what we define as emerging companies with revenues up to $25 million, focusing on the underserved segment of the market, which is above the business brokers traditionally and below the investment banks. Let's talk about our topics today. We're going to talk about the difficulty of raising capital. Certainly everybody knows that that's a tough environment out there. But we're going to talk about how you present to potential investors, what you're doing now, and we're going to suggest some things about what you might be doing wrong and how you can improve that to do it right. We're going to talk a lot about investor trust building, and the theme of what we're doing here is to not look at working with an investor and getting capital as a transaction, but more as a long-term relationship building. So if there are so many sources of funding, why is it so difficult to finance my company's growth? And why is it so difficult to find an investor. The growth of the United States economy, as we have heard, is really dependent on small business. But yet, when it comes time to find capital and find an investor, it's very, very difficult out there. So why is that? Well, one reason might be certainly the economy. We look at some of the charts here that are just recent. Real growth in the domestic product has dropped. Our unemployment rate is up at historical highs. So the economy certainly is an issue, and what that does is it creates problems for investors whose businesses and cash positions are very, very tight. And they're looking for liquid investments or investments that are certainly safe. Another reason of the economy is that many companies are just running out of cash as their business turns down in this environment. And we're seeing a lot of businesses being sold at fire sale rates. Fair values are very difficult to find, and when people find them, they don't believe that they're seeing what they're seeing, because people are skeptical as a result of this economy. So this certainly has a bearing on what's going on. At the same time, we have banks that are trying to meet their ratios based on the backs of very small businesses. We find over the last couple of years that the banks have changed their business model from loaning money to working with the government as an extension of the government. And here we see some headlines of how that has worked. Big banks tucked away $13 billion in profit from bailouts. Multi-trillion bailouts lead to multi-billion in bank profit, and big banks are back to pre-crisis profitability, but yet we hear the banks complaining that everything is still bad with the economy for them. When you think about funding, you need to understand there are different stages of funding, and so the question is, what funding stage are you at when you think about funding? There's the growth cycle here on the left-hand side, which starts with courting investors and then going to infancy, adolescence, prime, and then getting to a stable company. And then there's the downside where the company becomes bureaucratic, and if they are not able to adapt to the marketplace, they face dissolution. So you have to think about funding relative to where you're at in the corporate life cycle. We're going to obviously focus on the growth stages. If we look down here, as we start up the seed capital and maybe R&D money and then the startup funding, this is defined always by what we call FF&C, family, friends, and credit cards. That gets you to the first stage, which then maybe gets you to the expansion stage, and what you're looking for is to climb this growth area, then either turn the company into an IPO, maybe get it bought out through an acquisition or a merger, or another growth vehicle. So is it the economy? What is it? Or is it me? What am I doing wrong? Am I not meeting with enough investors? Am I not able to convince the investors that I meet? Am I not able to follow up on time? Is the business plan appropriately focused? Do I need to rewrite it? Is the company's risk defined clearly to those investors? If I could only make them see what's going on. That's a point where so many investors get to because they spend so much time looking for money, it's almost impossible to do that and build a business at the same time. So now I'm going to hand this over to Boaz Vinogradov, who will take it from here and talk about investor criteria and what we've learned in the past.
So we've looked at things mostly from the company point of view, the entrepreneur point of view, and whenever you try to get into relationship and into interaction that is hopefully a business interaction with anybody, you need to look at it from their point of view for a moment. And that's what we're trying to do in the next few slides. Investors are looking for you to be addressing a real problem. It can be a very small problem, like a fast food restaurant lacking in a specific area, strip mall, to a new technology, chemistry, you name it, that is missing in the world marketplace. It's the same thing. They want to see some type of problem being solved. The old idea that 17 grocery stores are making a living, 18 will make two, and therefore I should open grocery store number 18, doesn't really register well with investors unless you bring some market data that says that literally there's a need for 50 of them, and so number 18 is going to make a lot. But that's really not the common case. If your solution is unique in one way, whether it's the business model, whether it's the way you approach customers, whether the value perceived by the customer is different, bottom line, if there's a competitive advantage that can be clarified, then it's interesting. Management team is always important. And if you can demonstrate that your management team has done it before, then you can do it. But that gives all the 40 and 50-year-olds a chance, and a 24-year-old Zuckerman that comes up with a Facebook idea will not have been very successful unless he came up with a market need that is really so tremendous. And this is, again, one in several tens of thousands of companies get to be a Google or an Amazon or a Facebook story. The rest of us are, even when successful, don't go beyond a couple of hundred of millions, as it was my case at least. To an investor, success is more who's the management than the amount of capital they have or already have invested, and what capability do they have in executing the plan or the story that they just told me, much more than the unique technology or, I'm going to sell to the government because it's county government and it so happened that three of my brothers are the entire purchasing decision-making in that county. These things don't work. The execution and your ability to talk about the details of how your execution either already happened or is about to happen is much more important. We all show, especially if we are early stage pre-revenue companies, the beautiful J-curve of how we're going to make things grow fast. We show detailed ideas of how the capital is planned and how we're going to spend it. We tell that the ROI is going to be 5 to 10x, whichever is the case with your specific story, and that the go-to-market is literally a slam dunk. We just know how to do it, and trust me, because Mike the Great has done it 3 times before. They look really interested. Investors oftentimes are excited by your story. And I ask pointed questions that get you energized because, wow, they really understand what I'm talking about. And they compliment you about your idea, about your creativity, or about some of your execution and milestone reach, and they are literally giving you a good sense. And I promise to get back with you because, you're great next week. Only never to be heard from again. Why? The main reason is that the story so far has been about you. And anybody who's got money has the patience because they've shown the ability to make a living and grow their own personal wealth in this environment and in this economy and in this world. And so they know how the game is being played, and they are not going to make mistakes and look rude for no reason. Some of us do, but most of them don't. At the end of the day, these are type A personalities. And the balance so far has been all about you and very little about them. The next thing is that you literally tell them, now that you have them there, that you want the money now. You are extremely excited about your company, your product, your new technology. Assign what I'm saying to the stage and the type of issues that are correct for you. Obviously, if there will be capital, you can go much faster. I mean, we all know, and it's a common thing, that growth requires capital. So if you can get excited about the size of your opportunity, obviously that requires capital, and they should be energized about it as well. But what you are not showing so far is the excitement about the cash that you will make for that specific investor. Certainly not much details about when you will make the money for him, what kind of gross margin, what kind of capital efficiency compared to the alternative investments that he or she is looking for, what is your cost advantage, and again, how much you're going to return to them in how many years. If you go back to the movie from the 70s, Cool Hand Luke, then what we've got here is literally a failure to communicate. And Carl, would you take over?
Yes, thanks. As you can see from what Boaz went through, it's a disconnect. It's not so much that you can't find the right investors. It's more an issue of communicating with them in the appropriate way. Let's take a look at some of those things. One of the issues we talk about is telling stories versus selling the investment. And when we get contacted by people who are looking for funding, boy, do we get stories. We get stories. It's such a great idea, and we're doing this, and we've got distribution here. And we all tend to do that. We all tend to tell the story about the opportunity, but we do that to the sacrifice of talking about the ROI. So one of the things you need to remember is the story is not the main issue. The story is the context. You have to provide the context, but then you have to get to the numbers. The other mistake that new business owners make when they're pitching what they're pitching is they avoid talking about the risk. The risk is absolutely critical to talk about because it's unrealistic to avoid it, and you're going to look like an amateur if you avoid it. Let's talk about risk a little bit. You absolutely must discuss the risk. The investment is always a ratio of risk versus reward, but it's important to remember here that any kind of risk is a calculated risk. There are different kinds of risk, like there are different kinds of funding for different stages of businesses. The risk we're talking about here is not rolling the dice. The risk we're talking about here is the calculated risk that's going to allow you to get your product or your service to the marketplace. It's important to know a business is not about them falling in love with your story. It's about the cash that your business is going to produce, and if you produce that cash, love will come, and it will be a beautiful thing, but you have to take the right steps and go through the right stages. You have to be realistic. If you talk about the risks and you talk about the reality, you talk about the competition, you are going to look not only better, but you're certainly going to look more honest, and you're going to look like you've been through this before because you come across as realistic. And that's very important when you're sitting down and meeting with investors. Remember, the story is the context, the numbers are the main point, and you have to talk about the associated risk. Being realistic means you have developed plans that show how you're mitigating the risks that you define. So you have to define the risks, then you have to show and discuss how you're addressing those. If you don't do that, again, you're going to look a little bit more like an amateur. If you do that, you're going to be able to help put the investor at ease because these are questions that he or she is probably thinking about as you're going through the pitch that you're making. Otherwise, what may happen is they go away, they think about it afterwards, and they think about it without you. When that happens, then they start to build reasons in their own minds as to why the business plan won't work, and you aren't there to help them through the process. Boaz, what's the statistic that you had mentioned before when venture capitalists look at a pitch or a private equity firm? How much time do they have to give it?
5 minutes.
About
and
5 minutes.
They select one of the best of them, one of 250 opportunities, versus today it's more common that 800 or 1,000 investment opportunities go their way before they actually invest in one.
That's obviously at the higher end of the growth curve. More companies start out at the early stage, but the principle is the same. You have, just like in Hollywood, you have to have a pitch, an elevator pitch, and you have to be realistic, talk about the numbers, and talk about the risk. If you're not there and they think about all these problems, you get written off as a dork or a business opportunity that doesn't make sense to them.
This is actually Carl's picture.
Very, very
That's
good.
cute.
No, that's back when I was in high school. I don't wear the tape anymore. So, on top of that, as Boaz said before, here you are, you're asking for money. You're asking for money now, and you've got this sense of urgency that I got to close on them now because I'm never going to get in front of them again. So the question is, when did you last give a story-telling salesman your money? And that's how so many investors come across because, again, they look at it as a transaction as opposed to a relationship.
You mean entrepreneurs, not investors?
Yes, they look at it. Yes, I'm sorry. They look at it as a transaction instead of a relationship. And with that correction, I'm passing control back to you.
So what investors are looking for is basically return on and return of their investment capital. Since it is risk versus reward, the higher the risk, they expect higher reward. And if your risk type, not just the reward, if your risk type is not to their liking, they are not going to invest. Best example, go and research just about every private equity website and look for their investment criteria, and it sometimes describe one thing, sometimes another, but all of them will require 3 years financial and will require a minimum of $500,000 or $1 million in EBITDA in free cash flow from the business before you pay tax and depreciation and interest. Because they want to know that they have a level of certainty that your operation is already making money. Venture capital comes in much earlier, and they are willing to invest before there is a product, but when there is a pretty clear idea, even if sometimes they are more like angels that invest in an idea which they have to make a prototype and a product and whatever later on. You need to make a fit, and you need to qualify the person you're talking to. Because if they are interested in investing only $500,000 and you need $2 million, they still may be the right people if they like to invest with others. But if all they have is $500,000 and they like to get control and be the sole investor, then guess what? They are not, in this example, the right fit for you. So both the opportunity and the risk need to be a good fit for the investor. If you look for just a moment, most VCs in the funds that started in 2000 and later, 99 and later, have had negative results as they measure it with IRR, internal rate of return. But something more significant has happened since 2008. If you look at the bars, the brown part represents the amount of money that is reinvested in companies that are already invested in. This is the seed or the first time investment. And if you look at it, this amount, when we went through the bad days of 2009 and 10, this amount has not shrunk substantially. The more risky part dropped almost to half. And that is usually where the early stage companies seek money. If you think about it, the pipeline of new startups in this country, new technologies in this country, is look really scary because who's going to go public? We're going to have half the number of technology companies going public 3, 5, 7 years from now. Investors are looking for realistic exit plan. They are looking for something they can believe. What you're trying to do when you meet with them face to face and when you get the chance of presenting to them is whet their appetite enough for them to spend the time beyond the first 5 minutes or half an hour that they gave you to look more in depth into it. And your short presentation, as we said, must generate enough interest by addressing the investor point of view and by talking about your risk. If you want to make it a little more fun-like, it's like marriage. It looks very exciting at first. It's very difficult to get out of, and only the lawyers make money when you actually get out of it. They look for a plan, and I go back to the early part of this presentation. We see so many people, so many opportunities, especially in the early stage, that come to you. They don't have a business that manufactures any cash. They barely have a product, but they expect capital, and they don't have anything that somebody else can follow up on. Usually, nobody talks about exit because, we're going to be like Facebook. We're going to be so big that there's really no need to talk about it because it's going to be obvious when we get there. So we talked about the disconnect and the failure to communicate between the investor and the entrepreneur. And if you look at the points that we've tried to match from left to right, they want to see who's your customers. They look at the third point, and you don't have any secure deals, let alone repeat customers that you can produce to them, or a list of customers that you can produce to them, or furthermore, if you are a $20 million company and you're looking again for, do you have any customer support system, any customer management system? How do you make sure that you connect with customers not only when they have an order? I assume you had the time to look over the list. I'm going just to the last point, and, investors are going to give you their hard cash. And so they want to feel that they can influence the way you do things, and if they're a venture capital or a private equity, they are going to require preferred stock that will literally give them governance over your ability to make major decisions in the company. And that to many entrepreneurs is, no way, you don't know anything about the business. How can you step in and tell me that you will take decision control away from me? Viewing investors as a transaction, as we said earlier, exacerbates the divide because you keep on pushing as a good salesman for a decision. Are you going to be in or are you out? When their open questions about risk are there, about your ability to execute are there, chances are they're going to be out. So you need to build trust through the building or relationship, if you will, in our lingo, is building trust. And trust is not that we went out via relationship to 6 dinners or 7 different types of meetings. Trust is the following. You're trying to create some level of knowledge with the investor that you will deliver because you're going to be working with him for a long time. And he's going to be, especially if it's a VC or private equity, and you've all heard the horror stories of people that were backed by VCs just because expectations were set wrong from the get-go. But you've got to work there for 3-5 years, if not 7 together. Building trust requires time, and that's why you can't achieve it in one presentation. It doesn't matter how long it is. The best way to create trust is to create expectations for a specific performance and then delivering on those expectations. And once you do it once, you do it again, and then you do it again. So in detail, you start long before you need the capital, and you tell your story. And that's the only time you tell stories. At this point, you add to the conversation because you don't need the money now. So you can weed them out by telling them what really is the reward and what really is the risk, showing actual financials and talking about, listen, if I'm going to be too successful with this software algorithm, Microsoft is going to come after us. And they're going to put a ton of money, and in 6 months they'll be ahead of us because, you know what, they've got half the solution already, and they just need to push it. So if you're going to bring a new cloud solution, guess what? Google is going to come after you, and Amazon is going to come after you. And they've got more capital and people to throw at the problem than you can think of. And again, take this example and deploy it in your specific area of business. The next step is you tell them, I'm not looking for your money now, but here is what I'm going to do next. And here is where you create the expectation. You tell them about a specific action. We're going to go and close this specific customer. We are going to create a new feature. If you're a distribution company, we just signed up a new product that comes out of China or comes out of Israel or comes out of India, and here's how we're going to take this to the market. The goal is to achieve $3 million of sales for that product 6 months from now, 4 months from now, and 600 of coffees for us. When that happens, you walk away, and you leave them with the notion, you close the conversation with a promise to deliver a milestone. And you call them up and say, 3 months later, 6 months later, remember I told you we'll sell 3 million? Well, guess what? It's a week before the deadline. We sold $2.95 million, but we generated a little more than $600,000 for us in commission. This is a good time because you just showed that you can make something happen, and they were privy to the idea that it's going to happen, and now it's happening. This is a good time to start a Q&A session about what went right, what went wrong, and what additional learning you've done through that exercise, what happens in the market, what happens with the competition, what risks are coming through, what risks apparently are remaining just a possibility and are not really coming to play. Then you communicate exactly the same. What is the next action? What is the next milestone? When the result will be delivered? Then you ask for their advice. The reason you ask for their advice is not that you are interested, although if you are smart, you should be. The reason you're asking for their advice is that tomorrow morning they're going to give you money. One of the things that they're going to be concerned about most is whether they can or cannot influence you. Let's go back to the beginning of the presentation. You haven't shown them a real business plan. You were enthusiastically talking 45 minutes about your company, not stopping even to breathe, just like I do during the few last slides. And you expect them to feel like they can influence you because they leave this meeting and they know that they can't. The fact that you gave them a chance to ask questions and address with answers, still you focus the conversation on something that you have a deep know-how, and they usually have somewhat less of that knowledge you have encompassed. When you ask for their advice, you make it clear to them that, wow, I want to know what you think, and I'm open to your influence. More often than not, they'll give you an advice that will be easy to incorporate. And if you do it, now you set the stage for investment to happen. So again, you report reaching the next milestone, and now you've been setting the expectation. You demonstrated based on those expectations, not story that, listen, I took Nova public 10 years ago. Wow, nice thing. Different market. In 2000, every jerk and his uncle took a company public. That was before the dot-com explosion. So yeah, you had a software company, you took it public, no big deal. You want to show execution that you've done in recent time and on promises that you made or expectations you created on things that were not yet reality. And that's how you build trust. or at least in the investment community, that is the expectation for what trust is. Basically, performance. If you've reached this and you've done the exercise 2, 3, or more times, this is a good time to say, listen, you know that growth is inhibited or controlled by the amount of capital and shortage of cash flow. And I'm short of cash flow. So I can continue and tell you my next milestone. Or if you can help me fathom, achieve additional capital, then we can do much more. It is tough to build trust because you're giving them stories, you're giving them words, you're giving them spreadsheets of ROI and of financials, and they're giving you actual money. From the investor point of view, this is not necessarily a fair trade because they are buying the risk with money that they're giving you. And so avoiding talking about the risk, now that you've heard the whole logic, makes very little sense. And so you want to revisit the risks so the investors know that you are sensitive to the fact that you are taking money and what you're looking for that won't make that money work the way the plan calls for. But at this point, you're saying it from a position that you've built trust with them. They know that you can execute, that you're not just a storyteller. And that you can call a relationship. They had time to digest. You didn't ask for the money before. It was obvious that you should and how you're going to use it. Since you had several interactions with them, you had time to handle all of the objections that they might have, to talk about the reward, to talk about the risks, to talk about the market opportunity, and to talk about the execution team, about the processes, maybe incorporate an idea or two that they give you so they know that they can influence you. But by now, they know you. And by know you, I mean they know your business opportunity as well as yourself. The things that you can do is not ask for capital before you have established trust. Engage early and often. Talk about both your strengths and your weaknesses, if you will, the opportunity and the risks. What do you do well? What you do less than best? And how their involvement can help you. Much of the examples that are given usually by private equity and VC investors, not by banks, is that they've already sold a company to the potential exit partner that you're looking for, or alternatively, that they've done business because they came out of Microsoft, or they came out of Intel, or they came out of Conagra, or they came out of Cisco, and so they can open doors for you over there and ease up and shorten up the sales cycle to those big players. You should connect with as many investors as you can. But if you don't have the time to follow up, and if you are not going to ask for feedback and for referrals, don't approach additional investors because you're going to miss them. Trust is something you build by creating expectations and reaching milestones. And if you complete that with giving the full story of the opportunity with its rewards and what risks are coming with it, you are much more likely to get funded. With that, we open the floor to any questions you might have.
That was a great presentation, guys. And I just want to add to that, creating milestones, benchmarking your progress, and being able to build that trust can all be done with complete transparency in the funding roadmap. So it's the perfect tool to execute and implement exactly what you guys have been saying throughout this presentation.
Exactly, which is why our two companies are working together.
I would like to thank everyone for participating. Ruth, thank you very much for joining us from California. Thank you very much. We are ending the session now. We look forward to talking to you again at some point in the future.